Hey YouTube, and welcome back to my channel. So gold is over $2,000. As you know, gold is setting all-time highs in value and continues to go higher. Let's talk about why gold has gotten to where it's at, and let's think about where it's going to go in the future. So as I record this video, the ask price for gold provided by Kitco is $2,073.50. As gold has continued to make history, I think it's important for all of us to take a closer look at the economic factors that are driving gold's price higher. After all, it is knowledge above all else that will help us make the most informed decisions to better understand whether or not gold makes sense as a part of our own personal financial strategies. So, if you're interested in learning a little bit more about gold, you want to understand why gold continues to increase in value and where it may be headed in the future, then stay tuned to this video. Hey YouTube, and welcome back. All right, so welcome to Gold 101 with the Florida Stacker. And in today's video, we're going to look at 4 factors plus one additional wild card factor currently influencing the value of gold. We're going to talk about currency correlation, monetary policy, the current economic outlook, and of course, the supply and demand factor for gold. Finally, we'll tie that all in together with the wild card factor of 2020, which, of course, is the COVID-19 virus. So, whether or not you are new to precious metals, whether you're a new accumulator or a seasoned veteran stacker, I believe in staying up to date with the market as well as the changing market conditions in order to make the most beneficial decisions for our own personal financial futures. All right, so first, it's important to note that I am not a financial advisor, and the information I am sharing with you today is strictly for entertainment and informational purposes only and is not intended as financial advice. As you can see by the gold coins in front of you today, I do prefer to hold physical gold in my possession, and based on my current age, my employment status, and the overall financial position I find myself in today, I will continue to buy and hold physical gold as part of my overall financial strategy. All right, first let's start with a few basic definitions and concepts as a warm-up to what's driving gold's price higher. And first, we need to understand that today's money or currency is no longer backed by anything physical or tangible. Now, tangible items are items you can hold, like these gold coins here in front of you today. The US dollar, however, like other currencies, is known as a fiat currency, and fiat currencies are government-issued currencies backed by the government of that nation and not by any tangible good, commodity, or anything else such as gold or silver. The Central Bank of the United States, which is also known as the Federal Reserve Bank, maintains much greater control over the economy by working with the Department of the Treasury to control the money supply of fiat currency. Now, without anything tangible to back it, fiat currency can be printed endlessly. This, of course, increases the money supply of US dollars to the world. Of course, the Federal Reserve can also limit the amount of currency created through the Treasury Department as well. This, of course, is important to note as gold, like other commodities, is valued in the US dollar. Therefore, the strength of the US dollar has a very significant impact on the price and value of gold, which takes us to the first factor driving gold prices higher, and that is gold's US dollar currency correlation. So how are gold and the US dollar correlated? Well, they are almost always inversely correlated. Now, not always, but typically they do move in opposite directions. To put that more simply, as the value of the dollar increases, or as the dollar strengthens compared to other world currencies like the euro and the yen, the amount of foreign currency now required to purchase gold increases. Of course, this increased price reduces demand for gold, which lowers the price of gold. Now, in a similar fashion, as the value of the dollar decreases compared to foreign currencies, we see rising gold prices as the metal becomes more affordable to the rest of the world. It is very important to keep in mind that there are over 7 billion people on this planet, and less than 5% of that population lives in the United States of America. Therefore, as the value of the dollar decreases compared to foreign currencies, foreign prices for gold become more affordable, increasing foreign buying power for gold and in turn increasing demand. Now, let's take a look at the US dollar performance during 2020. As you can see in the graphic, when the world began to shut down in February to prevent the spread of the coronavirus, global markets began to sell off. Investors were, scared of what was going to come up, so they ran to liquidity, they sold assets to raise their stakes in the world's reserve currency, which of course is the US dollar. That strengthened the dollar. As you can see, by late March 2020, the US dollar had strengthened as demand for the dollar increased globally. However, as time has gone by and conditions in the United States, both from an economic as well as civil standpoint, have come into question, the world's faith in the US dollar has begun to decrease, and with it, also demand for the greenback. This lower demand, as well as the expanded money supply, is driving down the dollar compared to other currencies, which increases demand for gold. Now, it is no secret that the US dollar is and has been the world's reserve currency for a long, long time. That status as the world's reserve currency comes from the economic might of the United States and the security our economy presents. In general, investors across the globe have trusted that the United States economy will continue to outpace as well as outperform other markets. So it has become a terrific place for global investors to invest. Money flows into the United States as investments in U.S. companies or to purchase bonds or to simply hold the dollar in reserve. It's also important to note that the U.S. is a debtor nation. In fact, the U.S. is the world's largest debtor nation. Adding a little definition to that, the United States imports more than it exports annually. That does result in a negative net investment or cash outflow of U.S. dollars to other countries in the world, as we have to sell our dollars to buy goods in their local currencies to import. Very fortunate for Americans, the U.S. economy, as compared to other economies in general, even in its weakened state, is still very strong. And so the U.S. stock market itself continues to attract a lot of investors, foreign investors as well as domestic. So let's think about that for a second. If you're someplace outside the United States and you want to invest your local currency into Amazon, Apple, or Google, or any other stock listed on the New York Stock Exchange, in order to complete that purchase, you must convert your currency to dollars or buy dollars to invest in these companies. Now, similarly, corporations frequently attempt to raise capital in the form of bonds, and just with stocks, foreign investors, foreign banks, they must purchase dollars in order to purchase corporate and or U.S. federal government bonds to get that stable yield or dividend payments with the trust that their initial investment is going to be protected. These purchases, of course, increase demand for the dollar, which places a strain on the available money supply. Now, as the money supply or available dollars decreases, the value of the dollar begins to increase as compared to other currencies that are being sold to buy the dollar. If demand for the US dollar is decreasing as a safe haven asset, and our government is printing more and more money to inject into the market, naturally you will see a declining US dollar index, which is fuel for gold. So let's talk about the second factor driving gold prices higher during 2020, and that is the monetary policy, or more specifically stated, the current interest rates. Lower interest rates, like what we are experiencing today in 2020, are enticing to consumers, as a lower rate to borrow dollars extends the purchasing power of the dollar during low inflationary periods like today. This obviously compels Americans to go out and spend their money buying new Ford F-150s, Apple iPhones, new homes, new appliances, and other goods, which increases demand for both imports and domestic goods alike. This demand in turn increases the likelihood of new businesses emerging to meet growing demand for products and services, which propels existing businesses to hire more employees, hence creating jobs. Jobs, of course, create the ability for Americans to earn money, which they can then spend, which further boosts the domestic economy. That is precisely what we are seeing today. And in order to get Americans to spend their dollars, interest rates are low to draw spenders out and into the economy. Now, the flip side, however, to low interest rates is that other safe haven investments like bank certificates of deposit or government and or corporate bonds, well, they now pay a lower yield for holding the debt or giving your local bank a loan. Due to the lower yields received today from bonds and CDs and the duration of time that you must hold them in order to recoup your investment as well as the interest, well, they're out of favor. You're just not earning as much, right? And you have to lock your money up for a long time. So, favorability for these investments has decreased. So, with bonds and CDs now less favorable and a declining US dollar, where else do you turn to preserve your wealth? Well, I can tell you what that answer is, and it's obvious. It's gold. Now, the Federal Reserve Chairman has said on record multiple times that they will not raise interest rates until they have inflation where they want it. Right now, we are experiencing a little bit of inflation. As of June 2020, the latest consumer price index has domestic inflation at 0.6%, which is still below, well, it's 1.4% below the Federal Reserve's goal of 2% before they'll consider interest rate hikes. Given this information, we can expect interest rates to remain low until inflation increases. And as long as rates remain low, yields will remain low on other safe haven assets. And so favorability and therefore demand for gold will continue to persist. Okay, so let's move to the third factor driving gold prices higher, which is obviously tied in with the first two factors, and that is the current and future economic outlook of the global economy, or what I like to call personally the current fear factor, all right, or fear index. Now, before COVID-19 reared its ugly head in Wuhan, China last fall, there were factors at play that were already influencing gold to the positive. Those factors included trade tensions, trade wars, actual wars or conflicts, and of course, key elections. The more uneasy the economy is, that is to say, the more uncertain the future appears, the higher the likelihood of increased demand for gold. I mean, why not? When your currency in your country is in question, when the investments that you made are in question, when the government itself is in question, where would you turn to maintain your wealth through the chaos? Well, why not the world's first money, the original money, gold? Okay, so now fast forward to today, to August of 2020. You know that interest rates are low. You know that the Fed is increasing the money supply. You know that we are in a presidential election year. You also know that the coronavirus originated from China, which was already in trade negotiations with the United States. I think you're pretty familiar with how President Trump feels about China right now. You know that there is civil unrest in some parts of the United States and that unemployment is high while GDP is low. Is it any wonder, really, any wonder, while people across the globe are turning to gold? Until, of course, we see some of these factors begin to change, my best guess is that the fear factor will remain high and that gold will remain in demand, which will continue to drive up prices. Speaking of demand, let's now turn to the fourth factor, which is tied directly with our wild card factor during 2020. That fourth factor is basic economics and is gold's available supply. Gold is a commodity, right? As well as a store of wealth, but as a commodity, just like other goods and services, the higher the demand, typically the higher the price, especially when supply struggles to keep up with demand. Mining gold, at least mining it in scale that is large enough to make a difference, is not an easy industry to enter, and so there are many barriers in place to enter, which does prevent a rapid rise in supply. So let's tie that in with our wild card factor, and that is, of course, COVID-19. Now, due to COVID-19 or the coronavirus or the beer flu, Wu flu, Chinese virus, whatever you want to call it, governments all around the world, well, they began to shut down commerce in order to stop the spread of the virus. Of course, these shutdowns also impacted mining operations that mine for the gold. It shut down and stopped production at the refineries, as well as the mints that produce the end products, and even impacted the businesses that buy and sell to consumers. All across the supply chain, we have seen large demands for gold and silver at precisely the exact same time when production has slowed or stopped altogether. This is precisely why you saw premiums for physical gold and other precious metals increase dramatically as supplies began to run thin, and demand all throughout the supply chain has increased. Now, I'm not discounting greed from this scenario, okay? All right, I'm real here. But so long as people are paying the premiums for gold, the greed will continue, and why not? You got to remind yourselves the dealers are not your friends, okay? Trust me. They love me when I talk about their services, they love me when I promote their products, but the moment I have a complaint, well, it's usually a different story. Fault them all you want, however, they are a business at the end of the day, and like every other business out there, their objective is to make money. Businesses experience ebbs and flows in revenue and profitability, and the bullion business is no different. So they are happily charging what you're willing to pay. All right, so I need you to ask yourself, is gold going to go higher? Well, before you answer that question, let's start out by recapping how we got to over $2,000 gold in the first place. All right, so we know that a weakening US dollar happens when demand for the US dollar decreases or there is an increase in the money supply of the dollar. Both of these conditions persist today and will continue to persist until confidence improves with the US economy and the Treasury stops printing. However, turn on the news. The US Congress is in discussions right now about a second major round of economic stimulus. The Democratic led House of Representatives are asking for $3.4 trillion in stimulus. Now, ask yourself, does $3.4 trillion in stimulus increase or decrease the money supply? Well, I think you know the answer. So we also know that interest rates are at all-time lows. Now, while we are seeing some inflation in this country right now, 0.6% through the first 7 months, we are still well below the target rate of 2% that the Fed will, not even consider raising rates until we see about 2% inflation. This, of course, makes other safe haven assets like bonds and CDs less desirable due to the opportunity cost, and also drives more demand for gold. So interest rates, larger money supply, as well as less demand for the dollar. Until consumer confidence, of course, increases, along with a little bit of inflation to get those interest rates in check, well, gold is going to continue to remain in favor. Now, ask yourself another question. Are there any other economic indicators that are driving the fear index? And the answer is a flat out yes, right? There's major trade tensions with China. I think we all know how we got here. There's civil unrest in several cities in the United States. It's an election year. It's going to be a very bitter election with major consequences to our markets, depending, of course, on the outcome. And also, there's the 800-pound gorilla in the corner of the room, and that, of course, is COVID-19. Now, I don't know how you feel about the coronavirus, but regardless, it is real, and it has impacted our global economy in a vast way. The virus is still here. People are staying home. By and large, they're not spending their money, and this has created massive unemployment with marginal improvements over these last few months, okay? All right, COVID-19 has kicked us in the teeth. So, based on these factors I stated in this video, an increase in the money supply, low interest rates, disruptions to the supply chain, as well as all the other economic variables like an election cycle, lower GDP, high unemployment, et cetera, well, I don't foresee gold decreasing in value at all, really, during 2020. And therefore, I remain bullish on gold, and I believe that the value of gold will continue to increase over the next 6 months. I just don't see any of these conditions improving that quickly. So before we end this video, I'm curious to know, what are your thoughts on the value of gold, and where do you see gold prices going in the future? I'd like to thank you all for viewing this video today, and I also do hope that you learned something, or at least for those of you that know all this stuff, maybe you were able to look at the factors that have driven gold higher in the past, and hopefully that can help you make a more informed decision for yourself on where you believe gold will go into the future. So take care, everyone. Thanks again. I really appreciate it. Keep stacking. And of course, I'll see you soon on another precious metals focused video. Until next time, friends.